Okay, so this video is probably going to get me so many negative comments because let's be honest, every single person in this trading space believes they know what drives the market. Okay, whether it's highs and lows, liquidity, bounces off EMAs, order blocks, market structure shifts, fair value gaps, rejection blocks, you name it. Okay. Every single person, if you go just type in trading onto YouTube, you will see so much information, and everyone believes this is what trades, this is what markets, this is what makes the markets move. Now, they will back that up, and good on you, back that up with examples on the charts, etc., etc. But I'm going to put in my 10 pence, right? Now, this is my take. And this is, I also believe that this is how the markets move, right? But which one, I want you to think about this, which one actually makes sense? All right? Hold that thought. The stuff that you've been taught before, or what I'm about to tell you now, okay? First things first, if any of you watching this have had the privilege of going to Wall Street and looking at a trading desk or a trading floor, even at the New York Stock Exchange, every single person that's gone there said the same thing. No one is looking at candlestick charts. Doesn't mean that I don't use them to trade, but the big people on Wall Street do not care about a fair value gap. They do not care about an order block. They don't care about an EMA. Okay? What they care about is price. Now, I'm not saying, or I'm not trying to knock ICT and his silver bullet, but naturally there are times in the day when there is an influx of volume after lunch, 9:30, etc. Fine. That's when the traders decide to place their orders. But how do we know where they are buying and selling their positions? I'm going to give you my spin on it. It's not financial advice, but it's backed up by numbers. So I've got data for June and July, but I'm not going to go through all of it. We're going to just do August because it's the most recent that I have data for, and you can go and do this yourself. Okay. Now, before I make big claims, you need to have data to back it up. Okay. Now, what this shows you is all the dates in August from the 1st to the 29th of the opening price of ES, the high it got to, and the low, and what price it closed at for today. Now, percentage change to the high is represented by these numbers. The percentage change to the low is represented by these numbers. So, for example, the price opened here on the 29th. It moved up 0.03% and then went to the low of 0.93, just under 1%, and then closed for a change of 0.66. This shows you the average percentage change for the whole month to the high from open, and the average percentage change to the low, and then the final change. Okay, same with July. You see the data here, etc. And you can see. So what we're saying, okay, in August, the average price moved up 0.5%, and the low was formed at negative 0.5%. So what did that tell us? That tells us that the big money players are cool with taking a 0.5% change in the market and getting out. Okay? Data. If you're going to make claims about your entry model, you need to have data. If you ain't got the data to back it up and you've just got your results from your account, that's not telling the students or whoever you're trying to teach how the market moves and why they should be placing trades where they are. Look at these numbers, okay? They may look like random numbers to you, but they are very, very important when it comes to looking at these on a chart. And I'm going to go into some chart examples in a second. But isn't that alarming that the price changed to the high and low on average? It was 0.5. Now, if you know this, you'd be getting ready to buy at 0.5, or you'd be getting ready to short at 0.5, right? Okay. Now, you've seen the data, okay? How about some chart examples? Because really, we all trade using the charts, even though Wall Street don't, we need them, okay? I'm going to show you some chart examples now. And what I'm going to do is show you from a higher time frame down to a lower time frame. Okay, so this is the monthly chart of September. 0 represents where the month opened, and you can see the standard deviation levels from a monthly perspective. Now, if we just look at the daily, right? Market open there. We got a huge rejection at 0.25 on the first day. Coincidence? Maybe. Market then gets above 0.25. Where does it get to? 0.5. Once it gets above 0.5, you can see the buying off 0.5. It gets to 0.75. We had a huge rejection there because that is a big move for the month. Then the market reaches 1%, and then we start selling off for the last 3 days to 5 days of the month. Why? The monthly target has been reached. If you enter, let's say, 100,000 contracts to go long on the start of the month, and your trade gets to 1%, it's huge. Okay? That's a monthly. I don't expect people to trade on a monthly and a weekly chart. Okay? But this is the monthly STD levels and how you can use these in trying to find your buyers for the day or what areas you need to be aware of. So that's the monthly. Now, this is 1 week worth of candles. Okay? And you can see on the red line, this is where the week opened. This is a 5-day and a 20-day daily EMA. Don't use short-term EMAs, okay? And they're just to identify trend. Now, market gets to just below 0.25, 0.4, and we start to sell off. We had a sell-off down to here. Bearing in mind, this is a weekly STD level. So it measures from where the market opened at the week and gives you the levels accordingly. Sold off from 0.25. We got to around the 0 level and we start to chop, and then we get below 0. We get below 0.25 and we stop selling where? 0.5 for the week. That was enough of a bearish move for that week for the bears to say enough. Look at the retracement. Look at the retracement. 0.25, and then we dumped again. These are hourly candles, by the way. So tell me, STD levels ain't important, ain't exactly showing you where the market is moving and taking profits. What are we doing here? Really? Okay, but you will say, oh, we can't trade on a weekly chart. How can we trade on a weekly chart? We can't enter on an hourly chart. That doesn't make any sense. We have to, our positions get liquidated at 12 o'clock every night. Okay. This is just to use before you decide where you're planning to take your trades for the day. Now we'll look at some short-term time frames. Okay, let's look at this day, 23rd of September. Okay. 0 is normally the place where the market accumulates. Well, the market made a move down, got below 0.25, got to 0.5 and the 5-day daily moving average, and then chopped it up the rest of the day. Coincidence that it stopped around 0.5? Beginner's luck? What are we doing here? You can clearly see where the selling began and where the selling stopped. 0.5 to 0.75 is a huge move in percentage terms of price. Please remember that. Clear as day here. Accumulation at 0. Okay? Accumulation at 0 right here. Market moves. Take your position at 0.25. Aim for the next standard deviation. And what happens? Buyer stepped in. There is a discount. Price is valued at 728. Now it's 680. Buyer stepped in. What happened? They bought and they sold for a 0.25 percentage gain. Sellers decided, actually, there is room for the downside. Seller stepped in again. Guess where they stepped in? -2.5. And the price got down a few ticks below 0.5. You only need 10 points a day. If you're trading one mini on ES, 10 points with a 1-point stop loss of, let's say, 1 point on ES, making me do maths, is around $50. 50 down to here is around $600. Risk to reward makes sense, right? Okay. That was the 24th of September. This day was the 25th. Okay. Market got to 0, came down. Beautiful clean rejection of 0.25 and got to 0.5. Once it got below there, retracement to 0.5, down to 0.75, and there you go. Big move for the market to be down 0.75. Some more buyers stepped in. Getting chopped up here. Even if you took a trade here because you think it's going to reverse and go all the way back to 0.25, you've got your 10 points. When the market starts lagging and gets below, again, 0.75 in the PM session, when the volume comes in, you can see the buying down to 1%. Where did the market stop selling on this day? 1%. Exactly right there. Standard deviation level -1. Coincidence? Absolutely not. And if you ever get a situation where the market has got to 1%, this is an easy buy because 90% of the time, it does not go below 1%. I've only ever seen it go to -1.25% in the last 3 months. So if you took this trade, there you go. If you wanted to wait for confirmation, you wait for the standard deviation above, enter at 0.75, get ready to trade at 5. You've done your 15 points for the day. Whether you want to believe me or you want to believe the guru that you are following, whose entry model you are using, standard deviation is where the buyers and sellers are present. It shows you where they are buying and where they are selling. If you don't believe me, go on Bar Chart Official, download the historical data for the last 4 months and work out the average moves. And that is all you need. You do not need levels or 16 different levels. You just need your standard deviation levels and be careful of the high and low of the day of the previous session, of the previous day. That's it. Please like, please share, leave a comment, even if it's negative. I'll try and get back to you. If you're not sure, if you want some more explanation, we have a great trading academy. You can see the reviews on my channel and would love to have you on board.